When staring into a debt deflation abyss, every central banker in the world would choose to reflate. And that's where we are right now.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for June 9th through June 16th, 2025, while supplies last. First this week, we feature 1-ounce silver maples at just $3.09 over spot. Next, backdated 1/10-ounce gold maples at just $39.99 over melt. And right now, for the lowest price we've seen in years, 90% junk silver is just $1 over spot. And finally, 1-ounce Platinum Britannia are just $79 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Greg Weldon from weldononline.com. Greg, thank you so much for joining us today.
Pleasure, Elijah.
Well, it's great to have you today. I did want to discuss what we've been seeing in the markets and precious metals. We're seeing platinum and uranium make big moves as well. First, I wanted to discuss the bond market because you recently have been reporting on this. And really what we've been seeing over the last few months and maybe a couple of years now is this breakage of this 40-year trend, this 40-year bull market in bonds. And now we're seeing this reversing. So did you want to discuss a little bit about this, or did you want to talk a little bit about this and also kind of the implications for the broader financial system?
Sure, because it is the biggest thing going on right now, and you nailed it right there. It's the 40-year trend. So let's give some context to this because, as far as you can see already that I've been around a long time. So I've been doing this for 42 years. So I remember back when all this started, I've seen this entire cycle of lower rates of inflation and lower interest rates that date all the way back to Paul Volcker, 1978, 79. And what's interesting about this, before we kind of get to the history, is how Jerome Powell is a disciple of Paul Volcker. He said as much in his 2008 Jackson Hole speech when he first became, Fed president or Fed chair. And what's interesting about it is you look at Humphrey Hawkins' testimony from Volcker in 2021 and 2022, and you go back and look at Humphrey Hawkins' testimony, from Powell, and you go back and look at Volcker from 1978. I mean, it's like he stole Volcker's playbook, and here's the text, and it's almost verbatim in many ways. But there's a lot of differences to be made here because that's the beginning of the cycle. This is the end of the cycle. And the beginning of the cycle was defeating inflation with really high interest rates, which became Powell's playbook that we'll talk about when we get to 2018. But in 78, 79, he beats inflation. All right, the 70s, were a nightmare. Carter, wage price trials. You had the Iranian oil crisis. All kinds of hell breaking loose in 73. Not too much different than what it looks like out there right now to some degree. But following hard on the heels of that was the election of Ronald Reagan, this renewal of American spirit, and all this spending to outspend the Russians to win the Cold War. Well, they were able to do that because we had no debt. Zero. Talking about 1971, Nixon takes us off the gold standard. Public debt creation really wasn't a thing until Reagan came into office. And in the context of that now tying into, and I remember this day very distinctively, I worked in the gold and silver pits on the COMEX back in the 80s. And I remember the Plaza Accord in 1985. It was announced on a Sunday night. And I remember you had the Quotrex machine. There weren't computers. There wasn't all nitrate. It was none of this, man. Everything was paper in the pit. And you had a Quotrex machine that would give you prices and news. And getting on, waking up Monday morning, getting on the train, Quotrex machine in hand, finding out the Plaza Accord had been signed, which was a devaluation of the dollar agreed to by G20. And that was a big deal. And it really started this entire dynamic that you see in terms of bond yields, having peaked in 78, 79, then again in 81, and coming straight down and in sync with the dollar coming straight down. You had a dollar bear market from 1981 to 2008. And in 2008, then 2000, and then it had a double bottom in 2011, which, by the way, was the first debt ceiling crisis in the U.S., which went hand in hand with the EU bond crisis. So it was a pretty big deal in 2011 that people really don't talk about much, but it was also a major crisis. Double bottom in the dollar, since when it has gone A, B, C, 50% correction of the entire bear market. So you have, a multi-decade bear market, a 10-year perfectly mapped out correction to the upside, and now the dollar's breaking down. So not only is this a 40-year downtrend in inflation and interest rates have been broken, it's also a renewal of the secular bear market in the dollar that dates back to 1981, and all this dates back to 1981. Now, why is now different and why has the trend changed? It's simple, debt. And bottom line is I wrote in January in my year ahead outlook, several themes, one of which was a debt black hole, that we have crossed the macro event horizon. Physics, I'm a kind of a physics buff, I'm a math and science geek at heart. And when you look at what a black hole is, you understand that once you traverse the event horizon, it means you're in the black hole. You don't yet know it. The gravitational pull is not enough to pull you apart yet, but you can't escape. You can't escape the gravitational pull. And in the case of a debt black hole, to me, it's pretty simple, even though it's not simple at all, but it can be made very simple with one chart, which is to map debt, public debt, against GDP. GDP ran up, public debt ran, and it was pretty even keel with a negative debt spread for decades until 2008. So what changed? Of course, QE. And if you remember, monetizing government debt and printing money to do so was considered monetary heresy. And remember Helicopter Ben, when Ben Bernanke actually floated the idea, it was kind of considered lunacy. And I was even on Squawk Box on CNBC promoting my book, which I wrote in 2006, Gold Trading Boot Camp, in which I predicted the Fed would have to print money to save the real estate market, to save the consumer, and then if they had to do it to save the banking system too. And I was promoting the book. I was on Squawk Box and basically laid this out. It's very bullish on gold, which was then trading around $350 an ounce. And Joe Kernick called me a nut job for saying that the Fed will never monetize government debt. And it's like they had to, because in that case now debt rose up to a level that was the same as GDP. So now you're 100% debt to GDP ratio. Then came COVID. And the Fed was already pushing towards easing policy in 2019 because the economy had turned down in 2018. COVID didn't cause this. It just intensified it in a nuclear way. This would have played out over a longer term period even without COVID. But COVID generated such a degree of spending and debt creation that you pushed the debt way above GDP. All right. You're talking about Japan, Greece, some of these countries that have had these debt crises. You go back even Brazil and Thailand and Russia back in the 1990s, where they had debt crises and the currencies collapsed. So you tie all this into not only public debt, 36 trillion, but also household debt, 18 trillion. Now you're talking about 186% of GDP. Now, what does this mean? This is not, black and white, but essentially this means that to create $1 of new growth, you need to create $1.86 of new credit. And that's where we are, relying on credit to sustain growth. And we need to sustain growth to service the credit. So now you're in this cycle where you have to continue to do this or you face a debt deflation, the outcome of which is much more devastating than reflation. And I wrote in my book in 2006, some of which is antiquated, but some of which now applies more than it did even in 2006, which is when staring into a debt deflation abyss, every central banker in the world would choose to reflate. And that's where we are right now. And when you look at kind of what's happening here with pushing the world away from the dollar, in terms of trade, in terms of all these things going on in the U.S., it's a real perfect storm brewing to cause potentially a bond market crisis. You have 9.3 trillion of that 36 trillion in debt is due to mature in the next 12 months. You have to refinance all that at much higher interest rates when the interest cost has already exploded to more than $1 trillion. All right. Not only that, you have public borrowing for the fiscal year, which ends September. You didn't do any of it in the first couple of months. Now you have it all backloaded. That's 1.4 trillion in debt. You're talking about almost 11 trillion in debt to be refinanced or funded in the next 12 months. That's kind of insane. And yesterday, the market celebrated a successful 39 billion debt auction. And it's kind of like, that's chump change compared to what they're going to have to do now in perpetuity going forward. So you're going to have higher yields. It's going to force the Fed's hand at the same time when the consumer is choking on inflation that really you can't declare victory over yet. So this is a real tricky spot, but the only way out and the going forward will be the same. Print more money, bearish for the dollar, bullish for metals, bullish for commodities, bullish for stocks too. They just won't keep pace with the debasement and the purchasing power of the currency.
It's crazy hearing, I mean, you've been talking about this since gold was $350 and now it's almost 10 times that. And you're still saying that we have much further to run here. Some people might say, well, we've already had a tenfold increase in gold. Isn't this time to sell, right? What is your take on that?
Time to sell? No, not at all, because the dollar is just now breaking down. And this move in gold has not been based on all the normal factors. So this is what's the real twist to the plot here. If we're writing a TV binge-worthy series, this would be a great twist, because dynamic is people are saying that. And I get, I live in Palm Beach County. I got a lot more rich and more successful people around me than I am. And they're asking me, you see them in the gym, what do you think of gold? You can feel they're anxious, they're uncomfortable. Why? Because the debt, and you can't just keep doing this without repercussions on the dollar and what that means for the value of the dollar. So they ask me, should we buy gold? Isn't it too high now? Well, let's ask ourselves, why is it where it is? If it were where it is because the public was plowed in and Wall Street money had flowed in, then I'd say, sure, yeah, absolutely. Based on the parabolic angle of ascent here, which is almost straight up. But no, why? Because this has not been that. This has been central banks buying Poland, Brazil, China, all of these central banks to protect against the U.S. seizing assets. All this, it's become an asset war. It's a commodity and resource war. The world's already at war. It's just different than, fighting over land. I mean, we're fighting over different things, particularly resources. And when you take that into account, all this trade talk and all this tariff talk and all this bullying by Trump, while necessary to some degree, maybe taken the wrong tack to do it, all right, in the sense that we have now driven people away from the dollar, all right, people selling dollar assets to whatever extent, all right, even to the degree now that while it's lost its public feature on the front page, the BRICS unit, those countries, it's never been more a sense of urgency for them to do this and to make this happen. And in that context, they need to sell U.S. dollar reserves, take those proceeds and go buy gold with it, because they need the gold locally to back their portion of this currency dynamic, which is really amazing when you break it down to what it is. It's really quite cool in that it has so much flexibility based on the different countries that might trade, based on the percentages. It's blockchain based. I mean, it's amazing. And it will continue to push the dollar in terms of trade. Why? Because China wants it. And why does that matter? Because they are 3-2 larger than us right now in monthly global trade. It's that simple. So why should we be priced in dollars? You can make a case should be priced in renminbi. That's not going to happen either. So all of this, again, suggests that this buying by central banks that has driven this, while you look at the speculative side, open interest in gold and the futures market is very low. It's barely risen at all until just now, starting to rise. You look at the mining shares. You know that Wall Street money is going to come in there. And I've been saying this the past 2 or 3 weeks. It's one of these things where you go forward, AI kind of ran its course. Certainly it's going to have growth into the future. But in the near term, I think, you need more products. You need more things you could sell. You need more profitability. You need more energy. You need more things to happen before that's like going to have the same run that it just had. So it's kind of like, but you also see the depreciation of the dollar and people asking, should I own gold? And they start asking their wealth advisors, should I own gold? And we don't. Why don't we own some gold? All right. You get Wall Street money to move in. It's going to move into the names it knows, the big cap, blue chip behemoths in the gold market, the Newmonts, the Anglos, the Barracks, all right? And we're starting to see that happen. So that's why now you start to get the next push, which frankly will be the bigger push. And that's where, my original forecast for gold in the beginning of 2024 was 2650. That's when it's like 1790. And people are like, you're out of your mind. That's $1,000 higher. Well, now we're trading around 3,300. I don't think it's a stretch to say we could go to 49.45, which is a mathematical, measured move here from here. And, I'm not saying it's going to happen this year or even next year, but over the next 3 to 5 years, gold will be much higher. And to say that can't happen, I would counter that by saying, look at a chart of gold in something like Japanese yen, right? It's tripled since 2021. So all bets are off now. These markets, you see things like even in the food commodities, cocoa and coffee. I mean, the moves now from here on out, for a variety of reasons, all secular trend type of reasons, will be increased, intensified volatility and prices that you thought would be ridiculous to predict, just even a year ago.
No, we are seeing movements even more dramatic in silver over the last couple of weeks. Your take on this, because I know last time we had you on, you said that $50 was really within reach now, and it even seems more so with silver 36, touching 37 the other day. Your take on this?
Well, there again, the difference is the dollar, because, people were, of course, when we were bitching about silver, the ratio's out of whack and it should never be there. Because central banks are not buying silver. They're buying gold. Silver's not a tier one asset. Gold is. Silver's not back in the BRICS unit. Gold will. So the buyers of gold were not buyers of silver. So it didn't keep pace. All right. Silver, like platinum and palladium and, a lot of the commodities, based on the dollar. All right. And I think I said on this program, just wait, when the dollar breaks, silver will go. And here we are. The dollar has broken. It's making new lows today. And silver's on the launching pad. And again, it's, I think I said on this show as well, it's not a question of whether you will get to 50. It's a question of how fast we get there. And I think you are on the precipice of seeing that move take place. I would also add that the silver mining shares are breaking out. You want to see the miners lead the way. The GDXJ junior gold miners are outperforming gold now, and the SIL silver miners are outperforming silver. That's the ladder of leadership you want to see. It's all coming together, man, and it's required some patience and some understanding of the dynamics going on. But right now, the stage is set for silver to shine.
I was just talking 2 days ago to our mutual friend, Peter Grandich, and he was talking about how respectable the move in silver looks right now, considering, as you mentioned, that central banks are not buying silver really. It's not the big players moving into the silver market. It seems maybe it might be the little guy at the moment, but we're still seeing incredible strength.
Let alone that, you still have this kind of background dynamic that always rises its ugly head every now and then, that silver is a market that's short, by the institutional, bullion people, and that they manipulate this market forever. So, the powder cake could be there just even from that thing, which could finally be exposed. This is the age where all these things are being exposed, right? The political the child abuse, so all the things that are just despicable of being exposed. And you might add the silver conspiracy would be part of that. But again, it's kind of interesting, because I'll give you something that to me, again, we're so US centric and so dollar centric. All right. Look at silver in euro currency. All right. So silver in euro currency has been above 30 euro only twice before. 2011 and 79, I think it was. I'm not sure the exact date, back in the 70s. All right. Only twice. All right. And both times it closed above 30 euro for a month and it came immediately back down. Right. It has now been above 30 euro a month for several months. It's never happened before. And it's sitting right in new highs with this top pattern. I like to call this like the launching pad pattern. When you have a flat top and kind of this angle of ascent, to me, that's always kind of the gentry that holds the rocket. And when you drop that and you break through the top, you're off to the races. So when you look at something like silver and euro, even as the euro is rallying against the dollar, is holding above 30 euro for a couple months in a row, that never has happened before. So that's a very encouraging sign to me when you start to look at silver priced in other currencies, has kind of already broken out and is already, pushing new highs. And that bodes well for silver to reach its previous highs and then some.
And what about platinum right now?
Well, it's interesting because we just put out an alert on platinum 2 weeks ago, the PGM special. And, I have some pretty large hedge fund clients, and I'll tell you what's weird about it is I put the piece out maybe around 4 a.m. Eastern Standard Time. And I'll tell you by 6 o'clock, platinum is up $40. All right. It was unchanged, but I put the piece out. And what it does is it goes to show you that these markets are not deep, and you start to see any significant money come into them. These are the kind of price moves you could see. $40 in platinum in 2 hours. Where it doesn't move $40 in 2 years was impressive. And now it's broken out on a monthly basis. 1350 is kind of the next level. 1105 was the original breakout point beyond the medium-term breakout point, which was 960. So it's already been a huge move to, almost 1300, around 1250. Palladium is lagging, but also breaking out. I would say rhodium is kind of even in the same space. So again, this is the dollar dynamic. Platinum was not going to break out until the dollar broke down, and now you're there. What's interesting about that is you look at like Stillwater Mining, which is one of the platinum shares, or the two big Impala and Anglo Platinum in South Africa. They have broken out from very low price levels with tremendous technical bases in a big way. So again, even in platinum, It's the miners leading the way, which is exactly what you want to see, in terms of this kind of what I call the ladder of leadership in the precious metals. So yes, still very bullish on those. You look at, platinum versus gold is still, minus, $2,100, $200 off its all-time low, minus $2,300. I mean, platinum is still, the spread between platinum and gold is still twice the price of platinum. So, I mean, that to me is like, okay, that's an opportunity. Just waiting for the technical breakout, which we got 2 weeks ago.
What do you think is driving platinum at the moment? Because again, just like silver, central banks aren't buying it. It's largely an industrial metal, even more so than silver.
Yeah, and that's a good question. I'm glad you asked that because, yeah, it's a dollar dynamic, but it is also a supply-demand dynamic. Platinum is looking at its third straight year of deepening deficits on an annual basis, meaning that demand outstrips supply. And you have some of the more bullish, admittedly more bullish, pundits out there that follow these statistics very closely that are suggesting by the end of this year, you may have only 3 months of demand in an available above-ground supply of platinum. That's a pretty eye-opening, shocking statement. So the supply-demand fundamentals in platinum are also not only supportive, but bullish, because you have had this big price decline in platinum, and now you have this reversal in the supply-demand dynamic that price has not kept up with. So if you take that on a relative basis, platinum still has significantly more upside even from here.
Now, last topic I wanted to discuss was uranium, because I know you follow this quite closely, and a lot of our viewers are interested in uranium as well.
Man, we did that special last week and on uranium, and it exploded this week. It is just totally taken off. CCJ is the primary miner. Cameco, it's a new all-time highs. The URA has broken out to a so basically a 10, 12-year high in most of these, except for the miners. One place where the miners are not leading, but it really is the ETF leading, not even the price of uranium itself, right? So that's a little suspect. But the fundamentals are so bullish longer term for the price of uranium that there could be this lag. And you have this money coming into a market that, again, is not that deep. You have the situation where 69 new nuclear reactors being built right now. And in places like India, in places like Argentina, Brazil, Pakistan's got 3 of them being built right now. So this is global. A lot of it's emerging market. It is a necessity. You look at a place like China, which has, all this solar capacity, but they don't have the capacity to turn that into electricity. So they're big in terms, they have 31 of the 69 new nuclear reactors being built right now are being built in China. That's almost half. So that's a huge dynamic, and that's expected to continue, whereas the supply is expected to peak in the next 2 to 3 years and is barely keeping pace as it is. So to me, it is a little bit of a longer term play. And it is a little bit front-loaded on the speculative side because it's the ETF, not the price leading the way, not the miners leading the way. So there's a bit of caution always around this, but longer term, the upside is so significant that it's like, for me as a investor, trader, money manager, I have to participate because this could be a big move and you can't really tell. Will the market discount all this now, or to what degree will it wait for the reality of that to show up? The fact that the reality is so real. Not only that, but one of the new smaller, safer reactor types was just approved by the U.S. government. So expect to see the U.S. start to build out. That was kind of delayed, politically to some degree. This is a big deal in terms of supply-demand fundamentals going forward that will be, more important going forward.
And I know you're the founder of the Global Macro Strategy Report. Can you tell us a bit about this and what they'll find on weldononline.com?
Anyone that wants to get the special, we did the bond special Memorial Day. It's 60 pages, easy to read charts. You should see these charts. It makes it more visceral when you can visualize these things and see them in a sequence where you say, wow, I mean, that connects the dots and what you're saying is actually true. This is based on statistics and facts, not on my opinion. All right. I'd be happy to send that to you, or for information on the GMSR or the money management program, feel free to email me at gregweldon at Weldon Online. That's GREGWELDON at Weldon Online. We also do a podcast. You can check that out. Money_podcast on Twitter. And I'm on Twitter at Weldon Live.
It's a crazy world out there, but we really appreciate you breaking it down for us, Greg. Thank you so much for your time, and God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for June 9th through June 16th, 2025, while supplies last. First this week, we feature 1-ounce silver maples at just $3.09 over spot. Next, backdated 1/10-ounce gold maples at just $39.99 over melt. And right now, for the lowest price we've seen in years, 90% junk silver is just $1 over spot. And finally, 1-ounce Platinum Britannia are just $79 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.